Crash to boom. The markets this morning went down. Now they're going up. Crash to boom. What's going on? I've got some information here for you, and hopefully this will help you relax, calm, and just stay invested. I'm going to explain a couple of things now, and I'm going to show you why I believe we've been given a gift, why we've got such great opportunity right now, and all you've got to do is stay in the market. Shall I explain? Shall I? Have you tapped the like button? Do you deserve a full explanation? Have you liked it so far? Okay. Have you clicked subscribe? Okay. Let's do it then. Well, we all know the Fed rates have gone down 0.5%. Thank you very much indeed, Robinhood. It was passed on. They didn't have to pass it on. They could have said, no, we're already the lowest margin rate, but they did. They lowered it by 0.5%. Now, let me explain why crash to boom and why this is a great opportunity. Let me share everything on the screen with you so you can see really clearly. If we go here to make it a bit clearer, this is my portfolio on Robinhood. If I click the buying power, right, there you go. Can you see what it says there? There's the margin I'm using. If we scroll up, I might find it a little bit easier to use this. There you go. Right, if we scroll up and click view details, you will see that the interest rate has now dropped to 6.05. Now remember, they didn't have to do that. They could have left it where it was, but they've reduced it to 6.05, which would indicate next month when it goes down another 0.5% or 0.25%, it's going to go down again. Todd Burns, stay right where you are. I've been talking to you, trying to explain things, and I don't know if you missed it all about your comments. Please stay right where you are. I'm making a video right now, so apologies for those watching the video going, who's Todd Burns? It's one of my members. I take priority over making videos to my members. Todd, stay where you are. So as you can see, it's gone down. Now, what does that really mean? Look at that. Daily interest, $13.14. Daily interest, $13.14. Now, I took a screenshot the other day, just before this happened. Look, I go into my photos. 14.23. Over $1 a day, what, $1.09. All right, so let's put that into context and explain the discount you've got on the stocks now. And it's going to do it again next month. So let's go, is it $1.09? Something like that. $1.09 times 365. That's $397.85. 90% of a share of the S&P 500. VU in my case. Now, why is that great? Well, that basically means I can get one share for free, just about 90% of a share for free, because the rates have come down and they're going to come down again. Going to get another share. All right. Now, of course, we've got a correction today. Of course, we've got people profit taking. Why wouldn't they take some profit? It's perfectly understandable. There could be more, whatever. But what you have to remember is this. Every time that you trade, if you get fearful and you get out and so on and so forth, you're taking the potential risk of getting out at the wrong time. Then you're taking another risk of getting back in at the wrong time. So two potential mistakes. 95% of traders, day traders, lose, they make mistakes. So two chances at 95% chance you're going to lose. What if you do nothing? What if you just stay in? What if it goes down? What if it goes up? Well, this morning it went down a little bit. Of course, it's gone down a little bit. People are profit taking. And of course, the pound to the dollar now has changed. Going on holiday now is costing a bit more money. The dollar against the pound isn't worth as much. So you've got that change. That's going to affect things. However, if you had sold, and let's say it does go down, it's got to go down by a significant amount, because presumably you didn't do the whole thing in a tax-free environment. You didn't do it all on an IRA. Some of it you did in your main brokerage account. So you're probably going to pay 20% tax, depending on how long you've held it and so on and so forth. So you've got, if it's going to drop, you can't just jump back in again with a couple of cents cheaper, because you've now got to pay tax on all those gains. So for me, I've made about 30%. So I'm going to pay quite a bit of tax on the money that I've just sold. So it's got to go down by quite a way. Now then, because interest rates have gone down significantly, and they have gone down significantly, and they're going to increase, the cost of your borrowing is going to get cheaper and cheaper. In my case, I'm using margin. So I don't mind if the stocks go down. In fact, if they go down 10, 15%, I will just simply buy some more, because between now and then that they go down, that period of time, nothing just goes down in 5 seconds, right? The S&P, that is. Of course, some junk stock might, but the S&P isn't going to go down 60% in like 5 seconds. It's going to incrementally go down. As it goes down over time, I'm paying off my margin. I've been paying off margin now for nearly 3 months without buying any shares for nearly 3 months. My next payment would be tomorrow, but because it's Saturday, 21st of the month, it'll be on Monday. I've got money coming in. I'm going to pay off some more margin. So I'm just paying the margin down, and margin is getting cheaper and cheaper and cheaper. So I am looking to spend more money. I want to bring that back up again. Can you see there? It says right at the bottom of the screen, it says 52.93. For me, a good measure on the S&P, a good safe asset is 50%. I could go more than that, a lot more than that, but I choose not to, because that's relationship to my income, what I can pay off in a sort of relatively sensible period. I don't want to be paying off margin over 30 years. You know, I'm not 20 years old. I want to pay it off in some sort of measure. However, as my balance increases, so can my margin. So the margin's coming down. 52.93 is a very comfortable position. Of course, less now is going in interest. It's going to get cheaper. More people want to buy. More people want to be part of it. We got a new member there.
Savage Faith Creations has become a member.
Let me silver as well. I'll talk to you about that in a moment. So at the end of the day, if you do trade out this morning, you're now chasing the stock back in again. You've paid tax on it, more than likely. You're making a 95% chance of making a mistake that you sold at the wrong time. Because what if it goes up today? You're making 95% chance that you're going to get it wrong to get back in again. If you don't wait for it to go low enough, the whole thing was pointless anyway, and you're back where you started. In fact, worse off. So, this is not financial advice, but my suggestion would be, during this period, we've got a great opportunity to simply be paying down our margin, or just staying in, waiting for bigger dips. Because we've now got a stronger economy than we knew about before. Of course, it was always we know the future was always going to be the future, but we now know the future is the present. We know the strength of the economy. We know the strength of the businesses. We just covered all the earnings back in, July, August, September, in July and August, and we saw the strength, and I think it was something like, was it 72% of the S&P reported positive earnings? We know, and good projections. It was somewhere in that region. I forgot the number now. So we know the forward-going pegs are good. We know the forward-going earnings are likely to be okay. Could be better, could be okay, but they're not going to be disastrous. Forward going is good. Interest rates being reduced is good for business overall. Big mega caps don't bother too much because they make a lot of money on uninvested cash, of course. But generally speaking, things are going to be okay. But there's going to be a lot of noise now saying we're at all-time highs. Take your profits, bro, bruv, God knows what else. I hate those phrases. But at the end of the day, let that ride. Consider it all as an opportunity right now. Interest payments are getting cheaper. More people want to get out of uninvested cash, get into the market, remain in. Take off the table the 95% chances you'll get it wrong. All you've got to do is wait for it to go lower. Simple as that. Now, what if you're not in the market? What if you can't say, I bought a year ago, I bought 10 years ago? Because people that bought 10 years ago, 20 years ago, 30 years ago, 40 years ago, as it goes back and back, they care less. And because that proves time in the market means you care less and you're more secure. If you want to become that person, start the clock today. Let the clock start ticking. So a year from now, 2 years from now, 5 years from now, you're that person. You can't become that person who sits going, well, I'm up 5 million% because I invested 30 years ago, unless you start today. Today is when you start. And I want to put this to you as well. Even if we are at all-time highs, that doesn't matter a jot. It really doesn't. What's important is that you are in and you remain in. I'm going to share something with you now. I took down this thought last night. I was thinking to myself, my journey to $1 million isn't about the $1 million. It's kind of fun and it's something to do. But most importantly, it's the journey. It's the journey, and it's for what it will make of me. For what I mean by that is for what it will make of me to achieve it. In other words, spending the next 6 years with structure and discipline will make me a better person. It's not about the end goal. It's not about the $1 million, because what happens on day $1 million? I'm there now. Now what happens? Nothing. Nothing really happens. But it's what it will make of me to achieve it. It'll make me a better person for the next 6 years. My growth, my discipline, my structure, my intelligence, my wisdom, if you want to call it that, will grow. And it'll make me a better person. That is why you remain in. That's why you stay invested. You stay in the game. I hope that's of some help to you today. I called this video Crash to Boom, and a lot of people are worried now, thinking take profit, all-time high. Just remember, and I'm going to put this on the screen for you right now just to highlight this point. If we take the S&P, which of course what we're generally talking about here, there it is. You can see over time it trends up, and it always will. Not because it's a magic trick, not because it's a magic stock and you can't go wrong owning it. It's because money becomes devalued. And if you sit on the sidelines and do nothing, your money is becoming devalued. However, if you stay invested in the market, your money tracks with it and grows by 10% a year and compounds. No matter how high the S&P 500 goes today, 5 years from now, 10 years from now, it'll be higher. It's as simple as that. So all you have to do is remain in, take the chances of you making mistakes off the table. When we are going up and we're booming and we're at all-time highs, do nothing. Don't worry about it. Continue earning money, continue saving money, continue being efficient with your expenses and the way you live, reducing your margin if you are in margin. Hold the money in cash if you are holding in cash. Yes, you are earning some money now, and it's going to get less and less. If you've got cash sat on the sides, buy in the market. Buy a great business or buy a great ETF like the S&P. It doesn't matter that it's an all-time high. It doesn't matter, because remember, when I bought it in January, it probably was an all-time high, but it's not anymore. Just give it time and it won't be an all-time high anymore. Doesn't matter. As we said before, the best time to enter the market was 10 years ago. If not, today. It doesn't matter if you enter the market today. People are entering the market today every single day of the week. Every single person across the world who has a 401k, a regular job, who weekly, monthly buys the market, is buying at an all-time high. Millions upon hundreds of millions, if not billions of people around the world are buying the all-time high every single day. So don't worry about that. Money is going to keep coming into the markets and always has done and always will do. So don't worry if you buy the all-time high. Sit back and relax. Stay invested. Crash to boom. Who the hell cares? Get out the broom, Crash the boom, get out the broom. Crash the boom, get out the broom, and sweep it away. Click above my head for all the links. Do you like that? Down below in the description. That was quite good. Give me that one. I want a super chat for that. Down below in the comments. I want a super chat. I'm about to go on holiday. I want a really nice super chat that can buy me some fish and chips. Crash the boom, sweep away with the broom. There you go. Over here, I'll put something else. Down here, I'll put the most important video. Psychology of investing. Watch it. Don't fear. Stay invested. Watch it over and over again. I want everyone to watch that every day while I'm gone during October. When I come back, you'll be more calm and relaxed. Till next time, as always, take care of yourselves and each other.